All right. Hello and welcome back to the Wall Street Petting Zoo. I'm Christopher C. Smith,
And I'm Robert James Coburn.
and this is our weekly news review, looking at the news in the market this week. This week, Robert, Monday and Tuesday, we had a huge pullback in the major stock indexes. Partly that was because of the November manufacturing report that came out on Monday, which came in quite a bit worse than expected, showing that the U.S. manufacturing sector is continuing to contract. And we also, over the weekend, had some concern about the Hong Kong Human Rights Bill because Trump had signed the bills that Congress passed last Thursday over the Thanksgiving weekend. And investors were really concerned that this was going to blow up the trade negotiations between the US and China. This is something that you and I had talked about before, and you had expressed that you didn't think that Trump was going to sign the trade deal, and we discussed the possibility that maybe he would use it as a bargaining chip. But what we both missed, Robert, was that Congress had passed this bill with a veto-proof majority, so Trump really had no choice but to sign the bill. If he had refused to sign it, then it would have passed anyway. So it's really just a formality for him to sign it. And invest the reaction in the market to him signing those deals or those bills was pretty negative Monday and Tuesday, with the market pulling back quite a bit and a lot of fear coming into the market that this would torpedo the China trade deal. We also on Tuesday got some pretty bad news on there's this organization called the ISM, which releases non-manufacturing data on the economy. It's called the PMI. They basically put together an aggregate measure of how the economy is doing as a whole. And it came in really quite bad on almost every leading economic indicator. Consumer confidence is down, production is down, capacity utilization is down, inventories are up. It all looked bad except for the jobs number. So the labor market still seems to be doing okay, but a lot of the other leading indicators in the economy are looking pretty bad. So between that and the worries about the trade deal, there was a lot of concern, and the market pulled back quite a bit on Monday and Tuesday.
Yeah, Trump also said on Tuesday, and I believe this is his quote unquote bargaining chip with the U.S., is he basically said he may hold off on any U.S. China trade deal until after next year's presidential election, which is a lot longer than most people anticipated with the, all song and dance of, we're getting close to a deal. Most were looking forward to that deal happening before December 15th, and that is the deadline for when Trump is expected to raise tariffs on goods worth $150 billion. So this also caused the stocks to dip on Tuesday, that the news that he was going to just basically wait until next year's presidential election.
Yeah, and I wonder how much of that is just him sort of setting expectations for voters so that he doesn't get dinged on the election results for not having made a deal yet. But anyway, it does seem like he's doesn't have the kind of sense of urgency that investors would like him to have, and with the possible, you know, increase of tariffs on December 15th, that's a little worrying. That's coming up really fast. We've got basically a week to figure something out, and it doesn't really seem like we're going to get there.
Yeah, and then counter to news on Tuesday, that there was some positive news on that U.S. China trade war. Let me put on my tinfoil hat. And that was the catalyst to cause stocks rise on Wednesday, counter to Thursday when the Labor Department came out with that jobless claims that fell to the lowest level in 7 months. So I'm still holding on to my tinfoil hat with this whole U.S. China trade deal just being a conspiracy at this point of each day news coming that it's either close or it's not close, and stock market just makes knee-jerk reactions because of it.
It does seem like optimistic comments on the trade talks, the progress of trade talks, have become a way to sort of distract from bad economic data and from the fact that we don't really have a plan for implementing a trade deal. It just seems like at this point they're just goosing the stock market as much as they can in order to help Trump in the election. We also on Wednesday we had Congress pass another China human rights bill, this time targeting China's suppression of Uyghur Muslims in the Xinjiang province in Western China. So this adds some fuel to the fire of, possibly these bills interfering with trade talks. But surprisingly, the market didn't go down on that news. The market recovered a little bit Wednesday. It kind of seems like China isn't actually that concerned about these bills that Congress is passing. And you and I had talked about this a little bit, Robert. This is the one thing that we were right about, is that it doesn't really seem like these bills that Congress is passing are going to be deal breakers for the trade talks. China, at the end of the day, doesn't really care about these largely symbolic efforts from U.S. Congress to signal that we're opposed to human rights abuses in China. It doesn't really impact China that much. The measures that the bills are taking are largely symbolic, and don't really have any real effect. So this new bill requires the State Department to do an annual review of human rights in China and consider whether we should implement economic sanctions against China. So it's kind of an agreement to think about sanctions, but it doesn't actually implement any sanctions. I feel like fairly token efforts that Congress is making to signal that we're tough on China, but I don't know that these bills are actually tough on China.
Yeah, I agree that they seem purely symbolic because I wouldn't trust that anything would come out of them.
We also, that recovery on Wednesday also ignored the private sector payroll report, which I think you just alluded to, which showed that 67,000 payrolls had been added in November rather than the expected 150,000 in the private sector. So that's just over a third of the expected number. And that suggested that the labor market is slowing down across a wide variety of sectors, including mining, manufacturing, construction, and utilities, which is usually a strong sector even in a recession. Um, Analysts blamed it on the trade war and also on the decline of traditional retail stores. And the analyst forecasts were looking pretty grim on Wednesday, although Friday we got completely different numbers, which we'll talk about in a few minutes here. And another piece of bad news Wednesday was the release of a report from Realtor.com forecasting that home sales will fall next year by 1.8% and that home prices will be flat, which is bad news for the real estate market and for real estate and construction companies and real estate investors. So as of Wednesday, the economic news was looking really, really bad. And I was expecting that our message this weekend would be to start reshuffling your portfolio for possible recession in the coming year. But the outlook changed toward the end of the week.
Yeah, on Friday, the it was a blockbuster jobs report, which caused the stock market to rally, where the Dow went back above 28,000 points. So we're back up to where we started the week.
Yeah, we on Thursday we got some data showing that corporate layoffs were lower in November than they had been in October, so that improved the jobs outlook a little bit. And we also saw the trade deficit decline a little bit, although this was because imports have declined, not because exports have increased. So this is something that Trump has wanted to see, was a reduction in that trade deficit. Although I don't know that this is actually a good sign for the economy for imports to be declining, because it suggests that demand is weakening in the United States. But then, as you say, we got that blockbuster jobs report on Friday. We had they were expecting 180,000 new jobs in November, which was already a really high number. I mean, a lot of analysts thought that was too high, and it was widely expected that we would miss that number. But instead, we beat it quite a bit. We got 266,000 new jobs as opposed to the 180,000 that were expected, which is almost 50% above the forecasts. We got unemployment at 3.5% rather than the expected 3.6%. And we had only 205,000 new jobless claims rather than the expected 218,000. So it was absolutely great month in November for the jobs labor market. And we also got revisions of the jobs numbers from September and October. So the jobs numbers in those months were stronger than the original report suggested as well. So overall, really, really good. Only the wage numbers came in a little bit below expectations. We had a 0.2% increase in wages rather than a 0.3%. So analysts overall were really, really positive on this report, and the market's performance on Friday absolutely reflected that optimism. And so, even though we started the week looking really weak in the economy, at the end of the week, it's I don't know what to make of this, Robert. I mean, we got radically different jobs numbers. On Wednesday, we had a jobs report that came in at 1/3 of the expected number, and then on Friday, we had a different jobs report that came in 50% above the expected number. These reports are so noisy that it's really hard to know what to make of them. But so far, it's looking pretty good for next week.
Is Trump putting out these numbers?
Well, the Friday report was the U.S. government report, whereas the Wednesday report was the ADP report. ADP is a payroll company. The Friday report does include government jobs, so that's maybe part of it is that the government jobs are contributing somewhat to that number. But and I also think we're seeing seasonal holiday jobs being added. Maybe we're seeing a lot of companies, um, you know, add seasonal workers where rather than adding full-time workers. And plus, the other thing that's happening is that Wednesday report didn't include the GM strike workers coming back onto the payroll, whereas the Friday report did reflect that. So we had tens of thousands of those new jobs that are actually just strike workers returning to payroll. But even including that, the Friday report was way stronger than anyone expected. So, assuming that that number holds and doesn't get revised downward in the coming months, it's looking like the economy is surprisingly strong, despite, or at least the labor market is surprisingly hot, despite all of these other bad economic indicators.
Yep, the economy's strong.
So let's talk stock picks, Robert. How about your stocks that you watched last week? How'd you do?
Uh, well, so Salesforce was one of the main stocks I was looking at this last week. They dipped Wednesday on poor guidance. As the year winds down, some investors are selling off their poor performers, so uh, it may be a good time to watch and buy into the weakness of Salesforce. It is a strong growing product. I mean, 1 in 5 companies use the CRM software to track sales leads. So I'll be probably looking to buy the stock if it dips below 150. Right now, I think after their quarterly earnings, they dipped down to about 157, and their highest was at like 165. They were trying to eclipse 170, but I don't think they were able to do it. Zoom. Now, this one, it's crazy because I'm just saying buy, buy, buy. That is all I'm saying about Zoom right now because with sales up 85% year over year and revenue doubling year over year, it is bananas that people are selling off the stock, which dipped 10% on Friday. And analysts are saying like you could not have a more perfect like earnings report, but apparently perfection is not enough because people were selling off the stock. And I attribute this to probably, people who own stock during the IPO. They're not happy with the price. They just want to sell their poor performers off before the end of the year. Or it's the employees that, it's after the 6 month or whatever restriction period where they can't sell their stock. They're now selling off their stock because they need money. But the stock dipped 10% on Friday on a good earnings report. So I'm saying this should be a good buy. It's expected. I expect the stock to reach the $100 mark by the end of 2020. So definitely buy this stock. And Dollar General. So I was expecting Dollar General to follow suit with Dollar Tree as I was watching that the week previous. But they actually reported a good quarterly earnings report, but it didn't really move the needle too much. So it kind of stayed the same stock price the whole week. And it seems that Dollar General has a better handle on their business compared to Dollar Tree. So it's probably a good long-term investment. But the latest earnings report didn't really move the needle on that. What stocks are you looking to look at this week, Chris?
Well, first of all, let me say that I did pretty well in both Dollar Tree and Dollar General this week after listening to your review last weekend. So thanks for that. Especially Dollar Tree, I made some money, and I think Dollar General probably will follow suit in the coming weeks. So appreciate that recommendation. And I'm curious what you think about with something like Salesforce, where it's already captured like a fifth of the market. How much room do you think there is to grow? Because I always wonder with stocks like this, like unless they release some new kind of product that taps into a new market, like is the market already saturated for something like a Salesforce, you know?
I think if it gets to the point where they're in 2 out of every 5 companies, it would say that they're saturated the market because let's put it easier. Not every company is obviously going to need CRM software, or at least CRM software of Salesforce's stature. But there are still some companies. There's 10% market share in SAP, and to be frank, I haven't actually worked with any company that actually used SAP software. Salesforce is all cloud-based and is simple to use. There's so much integration. I mean, they host Dreamforce, and to me, it's a strong growing product, and I feel like it should provide more growth going forward. But in terms of immediate growth, yeah, it's not gonna unless they drop something brand new tomorrow, it's not gonna cause the stock to spike. But over time, I believe the stock will keep rising.
Hmm. I agree with you about Zoom. I think you make good points about the expiration of the restrictions on selling, and also just the end of year profit taking, well, loss taking. I think that you're probably right about why that stock is dropping. So I'm going to have to look at that one this week. I think that's a good recommendation.
Yeah, it's a good thing to know too. Zoom is run by one of the former Cisco engineers. Like the guy who runs Zoom is a former Cisco engineer, and the story goes that he actually wanted to focus more on video chat with companies because he thought that was the future, and Cisco kind of dismissed that. So he left the company and started Zoom, and the guy who started Zoom went from being just a regular engineer to now, I think he's almost a billionaire now.
Huh. Interesting.
Yeah.
Okay, well, I've got three recommendations here, and I decided to do one long-term recommendation, one medium-term recommendation, and one short-term recommendation for those day traders. So here's my long-term buy and hold recommendation. This is VIG. It's the Vanguard Appreciation Fund. Basically, this is a fund that holds dividend stocks that have a history of also increasing their share price. So rather than holding all dividend stocks, it's just holding dividend stocks that have also grown their share price over time. Most dividend funds will underperform the S&P 500 in terms of share price, but VIG historically has tracked pretty close to the S&P 500 while also paying a 3% dividend each year. And it has outperformed the S&P 500 during recessions because, of course, dividend stocks are the defensive stocks that investors shift into during a recession. So this is a great fund to hold long-term for a steady cash return and also a bit of protection from risk of recession. And it's, I believe, the only ETF that has a 5-star rating from Morningstar. So this is probably one of the better things to hold in the market, especially given the risk of recession sometime in the next couple of years. My medium-term recommendation is Baidu. BIDU is the ticker. This is a Chinese search engine company. It's the Google of China. And it's way down this year because of the trade war and also falling ad revenue. Baidu has seen in the last couple of years their ad revenue cut off by very large percentage. So it's dropped from highs in the 280s in 2018 to the current share price at in the 110s. So we've seen, way more than a 50% drop in the share price. But Baidu has a huge cash reserve, and they've been reinvesting that cash to develop other products to expand their product offerings, including streaming services, cloud services, autonomous cars, and my favorite, artificial intelligence. Baidu has absolutely crushed on its last two earnings reports with not that much movement in the stock, despite those massive earnings beats. And also, Baidu has, in the last 2 months, filed 5,742 patent applications related to AI. It has filed more patent applications related to AI than any other company in China. So I fully expect this share price to go back to $200 per share within a year or two, especially as Baidu continues to increase its investment in AI. When I look at the earnings chart, if you've watched my educational video, by the way, on how to determine the fair valuation of a stock, then you will know that I use the Zacks price and consensus chart to determine whether a stock is undervalued or overvalued. Given the momentum, the upward momentum in earnings forecast for this stock, I consider this stock pretty significantly undervalued, and I think that it could start heading back north pretty soon. So this is one of my very favorite investment theses in the entire market right now is Baidu, and I would look to maybe swing this for a year or two. Then the short-term one is Cassava Sciences. SAVA is the ticker for this one. They got some positive clinical trial data on their Alzheimer's drug on Friday. The stock price spiked and then came back down by the end of the day. Alzheimer's is sexy. Analysts love this. One analyst increased the price target from $3 per share to $6 per share on this news. Overall, Cassava Sciences has a 9.4 out of 10 analyst summary score. Most analysts rate the stock a buy. The average analyst price target is $3. And S&P Global Market Intelligence rates this undervalued at the current price of $1.79. So there's a lot of room to move up to that average price target of $3. Sava has beaten analyst estimates in the last 2 quarters on their earnings reports, and it looks to be a pretty well-managed company. So this was only phase 2 clinical trial data, so there's quite a long time for this drug to come to market. Typically, you want to see phase 3 clinical trial data to have any confidence that a drug will actually reach the market. But so far, so good. It looks like Sava could bring this Alzheimer's drug to market in the next several years here. So the stock price moved up pretty fast in the last week, but it came back down a little bit. And I think that we will see a continued correction early next week to either the 170s or the 140s. Either of those dips would be a good buying opportunity for a move higher, and I think that once it hits one of those support levels, it will bounce from there. So I would buy a little bit in the 170s, and then if it reaches the 130s, 140s, I would buy some more there and look to profit from a bounce. This is going to be a high-risk play, but it's also potentially high reward. So anytime that you're trading these small biotech companies, they're very volatile. And so I would not bet a great deal of your portfolio on this, but this is kind of a fun play for the day traders and swing traders who like to try to capture big moves very quickly.
I've never heard someone say Alzheimer's is sexy.
Alzheimer's drugs are sexy in the biotech market.
Yeah.
But Alzheimer's as a disease is obviously not sexy.
Yeah. All right. So the stocks I'm watching this week, I actually had a long list. I had to curb it down because just there's so many companies to look at this week that are reporting earnings. So I'm just going to start off with AutoZone. So I obviously have not paid any attention to this stock, as I didn't know the stock traded above the $1,000 mark. They are expected to beat earnings, although now may not be a good time to buy unless they somehow miss earnings. But if they do miss earnings, which they're not really expected to do, I would wait for the stock to dip before you decide to invest in AutoZone. It would be a long-term play. But at the same time, I feel like your money would be better off putting it either into Apple or an index fund at that price. Stocks that usually trade that high, I mean, you're not going to really see that much in return unless you're in it for the long term. And you trust that AutoZone isn't going to fail as a business. GameStop. So this right here, this is a sinking ship without much direction other than down. The stock trend line is just going down for the last 5 years. So with more and more gamers going to buy their games online through online storefronts, and without GameStop changing much of their core business model of buying used physical games that people are buying fewer and fewer of, this is less of a long-term play and more of a short trading options game. So for those traders out there that do options and want to short GameStop, I mean, this is the company you want to roll with because their stock has continuously gone down. So even if they were to post good earnings report, if you do decide to play GameStop, you will want to basically ring the register and get that money out quick because that profit's quickly going to dwindle. Another stock I'm looking at is Dave and Buster's. So if you listened to their last investors call for Dave and Buster's in June, you will know why this stock tanked. After almost surpassing the $60 mark in May, the stock basically fell down hard. Like it went down more than $10 in a day after the June conference call. So it went down to about 40, and it trickled down under 40 to about like 38 for a little bit. Right now, I think it's back up to around 50, but I think the people in charge here have been doing a little bit too much drinking and playing games rather than improving their business. Unlike GameStop, where a changing landscape is causing them to take on water, Dave and Buster's appears to be taking on water because they're literally the ones putting the holes in the hull. So don't be fooled by their numbers last quarter, as they posted an 8% rise in sales, but those gains were due to a rising store base. So while existing locations declined 1.8% in revenue, this is similar to how the franchise company Subway would have greater revenue, but eventually you run out of new locations, and the current locations end up being more of a drain on profits than it's worth. So definitely not one I recommend investing in, but I do recommend, if you play the options short trading game, this is probably another stock you want to look at. Lululemon. So while most expect Lululemon to beat expectations and cause the stock to continue rising, I would advise those looking to invest to wait and see if there's another sell-off, as there was a major sell-off of the stock in Q4 of last year. So around this time last year, a lot of people sold off their stock because they just wanted to ring the register, make sure they got a bunch of their money, because Lululemon stock has performed very well over the last 2-3 years. So here we are a year later, and the stock is even higher than it was last year at this time. So I would say wait for the earnings report, see how the stock reacts. If you're looking to invest, it's good long-term investment because this stock has just been white hot since 2017. And then the last stock I'll be looking at is Adobe. So after reporting soft guidance for Q4 in their last earnings call, the stock dropped about 5%. But with news that they signed a deal with Rite Aid, this may get Adobe back on track and back above the $300 mark. So definitely also a long-term buy for Adobe, and not a short one.
Great. Well, folks, if you enjoyed our episode this week, if you learned something that's useful to you, please consider supporting the podcast with a like, share, or comment. If you follow us on YouTube, you can definitely find our links to our social media pages underneath the video. We've got Facebook and Twitter. You can tweet at us, or you can like us on Facebook. And also, we have a referral link for Webull. If you go sign up for a Webull account and deposit $100 in your account, then you get a free stock. We get a free stock that helps support the podcast. And thank you guys so much for listening. We will see you back at the zoo next week.